Welcome to How To with Mia and Ziad. How cool is it that investing is now a hot topic? At least it makes us feel cool working in finance. Anyways, as always, please hit that subscribe button and like button on our YouTube channel and follow us on all of our other social media accounts. The handle is Gerber Kawasaki for all of them. And today we will be talking about the common mistakes that beginning investors make, so that if you're a beginning investor, you're not making these mistakes. Remember that none of the information that we are talking about should be taken as personal advice. Please reach out to your financial advisor for questions about your specific situation. And with that, let's get started.
You guys should be patting yourselves in the back. You have taken the biggest step you need to improve your financial situation and have gotten some money invested. Now, what we want to do is just talk through some common mistakes that beginning investors make and provide some professional advice on what you can be doing to make sure you're being smart about improving your investments and your finances. Let's get into it.
A big mistake that first-time investors make is with concentration. You've probably heard the saying, don't put all of your eggs into one basket, and that's exactly what we're talking about here. So yes, we would like to say that every company that we're investing in is going to the moon, but that's just not always a reality. It's definitely not safe to put all of your money into one stock. Even the best of companies carry market and business risks that could greatly impact the company and your profits. If you put all of your money into one company, your money really rides on how that company does. And who knows what could happen? I mean, a global pandemic could hit, and that could come into play. You also want to watch your asset allocation over time. Rebalancing is when you return your portfolio to its target allocation that you have in your investment plan. So if you start out with 60% of your money in stocks, 40% of your money in bonds, it's not going to stay that way forever. If your stocks do really well and now you're at 70% of stocks in your portfolio, at some point you're going to have to sell that 10% and move it to bonds. But this is all dependent on your specific plan.
A lot of people, when they start investing, want to buy and sell investments within a few days or a few weeks. You want to get out of certain companies and get into new ones. Don't. Be patient with how you invest. If you're buying and selling within a few days or a few weeks, you're not investing, you're more trading. And that's a much harder approach to investments. When it comes to investing, do your research. Look into the companies that you're buying. Be confident that they're going to be growing, not just for the next few months, but over the next few years, and hold on. That patience is key. It's going to save you a lot of time, a lot of stress, and give you a much higher likelihood of coming out on top with your investments.
Okay, so something else that you do not want to do is buy into the hype of companies without doing the research. It's really easy to get caught up with a company that an influencer swears by, and it's totally fine to get ideas from videos and articles that you see online, but you really should be looking into a company yourself and seeing if they're properly valued. Remember, a company could be great, but it could also be way too expensive for what it's worth. So really, we encourage you to avoid following the herd.
One of the most important things when it comes to approaching your investments is not letting your emotions get the better of you. The market naturally fluctuates, and believe it or not, it doesn't always go up. There are moments where you have down periods with your investments. When you do have those moments where your investments are going down, don't panic. View that as an opportunity. If you have extra cash on the sidelines, now's your time to get into those companies that you like at a discount. And if you are holding investments, remember your goals with those investments. Take a step back. Ask yourself the questions, what are my investments intended for? When do I need this money? That's going to make you feel a lot more comfortable of holding through those periods of volatility and fluctuation. Beyond that, don't get too sentimental with a specific investment. Just because an investment has made you a lot of money in the past doesn't guarantee that that's going to happen in the future. And so if you do have a large amount of gains with a specific investment, sell a little bit, take some profits, lock in those gains. It doesn't mean you have to sell everything. You're still participating in the future growth, but at least if it does go down, you have locked in some profits. The question I like to ask my clients when they're in this situation is, if you have the same amount of money in cash that you do in your current investments, would you be making the same investments that you're making now? If the answer is no, then take a deep look into the positions that you have and make any adjustments as need be.
This is going to be a wild statement, but stocks don't always go up, and it's really important to pay attention to your risk tolerance and keep your investments in line with your capacity to take on risk. Everyone thinks that they're open to huge risk until being risky moves you into the red direction. Money is emotional, but you can't let your emotions take over when volatility hits. Risk can come from more than just buying out there companies that don't have a product yet or are just IPOing. Risk can come from lack of diversification into different asset categories. You have to look at the full picture and think, how long is it going to be until I need this money? If your time horizon is far into the future, then you can probably take on a little more risk than the average person. But if you're planning on retiring in 5 years, then you don't want to take a chance on losing a lot of money.
While we're talking about investments, we also want to set the right expectation and make sure we're being realistic on how we plan around our investments. The last thing you want to do is expect to get rich quick or expect your investments to go up 50 to 100% in value in a single year. That's never going to be guaranteed, and in order to have the chance of doing so, you would need to be very concentrated in some very high risk, high reward type of positions. It's a lot more in line with gambling than it really is in long-term investing. On average, the American stock market has gone up 11% a year for the past 70 years. If you plan your finances, savings, goals around a return a little bit less than that, then you're going to feel much more confident by your financial plan's success over the long term.
Well, thank you for joining us this week. To make sure that you don't miss next week's fantastic episode, hit that subscribe button. And if you have any questions about anything that we discussed today, or you have an idea for an upcoming episode, then give us a call or shoot us a DM. Our number is 310-441-9393, and we are here to help. We'll see you next week.
See y'all next week.